Hi, everybody. Welcome to Friday's Focus on Finances. My name is Jamie Fleming, and it's hard to believe that we're almost halfway through 2022. So I like to take this time midway through the year, close to it, to talk to my self-employed people out there. And if you are self-employed, you want to check out a solo 401k and if that would be beneficial to you. Because just because you're self-employed doesn't mean you can't reap the benefits of a workplace retirement plan. So check out a solo 401k, which offers similar tax benefits to an employer-sponsored 401k. Plus, you can sock away almost 9 times more per year than an individual retirement account or an IRA. So what is a solo 401k? A solo 401k is a tax-advantaged retirement account for self-employed business owners and spouses who work for them at least part-time. The solo 401k is also known as an individual 401k, one participant 401k plan, or self-employed 401k. So don't be confused, they're all the same. People who have full-time jobs with access to workplace retirement plans may also save for retirement in a solo 401k using money earned from a side hustle. There are no age or income restrictions limiting who can open and save in a solo 401k. You may be able to contribute up to $61,000 in 2022. And if you're 50 or older, you can make an additional $6,500 in catch-up contributions. So let's look at one of the most popular self-employment plans, the SEP IRA versus the solo 401k. When deciding how to save for retirement, small business owners with no employees beyond their spouses generally choose between a solo 401k and a simplified employee pension IRA, or also known as a SEP IRA. Both accounts give self-employed a tax advantage way to invest money for retirement, but there are a few key differences that can make the solo 401k a better fit. You may be able to save more with the solo 401k. With the SEP IRA, your total contributions cannot exceed 25% of your net adjusted self-employment income, up to $61,000 in 2022. Unless your business income is substantial, you may be able to save more in a solo 401k. Like a workplace 401k, there are employer and employee contributions for the solo 401ks. You can contribute up to 100% of your net adjusted self-employed income, or $20,500 in 2022, whichever is less, as the employee. You're also the employer. So as an employer, you can contribute up to 25% of your net adjusted self-employed income. Plus, individuals who are 50 or older can make additional catch-up contributions of $6,500 a year into the solo 401k. There's also a Roth solo 401k option. If you'd prefer to make tax-free withdrawals in retirement, you may want to choose a Roth solo 401k. SEP IRAs currently only allow pre-tax contributions and are not available as Roth accounts. Catch-up contributions for savers who are 50 or older can also greatly benefit. For those under 50, you can contribute an all-in maximum of $61,000 in 2022 to a solo 401k or a SEP IRA, regardless of whether you do it as an employer or an employee. But for savers who are 50 and older, a solo 401k allows you to make additional catch-up contributions of $6,500 as an employee. SEP IRAs are only funded with employer contributions, so catch-up contributions are not allowed in the SEP IRA. So let's look at tax advantages of the solo 401k. Whether you choose a traditional or Roth solo 401k, you get valuable tax advantages. Contributions to a traditional solo 401k reduce your taxable income today, and you can make Roth solo 401k contributions no matter how much you earn each year, as with a conventional 401k, Roth 401k. So traditional solo 401ks. Contributions to a traditional solo 401k let you reduce your taxable income, helping you to reduce your current tax bill. Any money you invest then grows tax deferred until retirement. Withdrawals you make in retirement are taxed as regular income. You may owe also a 10% penalty in addition to ordinary income taxes on withdrawals you make from a traditional solo 401k before age 59 and a half. This is the same for traditional 401ks with employer-sponsored plans. Roth solo 401ks has income gaps that prevent high earners. Just the regular Roth IRA has income caps that prevent higher earners from making contributions, but there are no income limits with a Roth solo 401k. Like other Roth accounts, contributions come from income that's already been taxed. Instead of an upfront tax break, any withdrawals from a Roth solo 401k made after 59 and a half are tax-free as long as you make them at least 5 years after you began making contributions. You may face penalties if you withdraw money saved in a solo 401k before you turn 59 and a half. A Roth solo 401k lets you withdraw contributions, but not investment earnings. And that's where a tax penalty may come into place. So your contributions to a Roth solo 401k come out penalty free, and your earnings in a Roth solo 401k may have that 10% penalty if you do withdraw those before 59 and a half. But because you cannot choose to withdraw contributions exclusively, at least part of your withdrawals will be subject to taxes and penalties, again, prior to 59 and a half. So should I choose a traditional or Roth solo 401k? For many investors, deciding between a traditional or Roth solo 401k comes down to whether you believe you're in a lower tax bracket today than you will be in retirement. If you think you're paying lower taxes now, you may choose a Roth solo 401k. If you anticipate being in a lower tax bracket in retirement, a traditional solo 401k may be a better bet for you. There's another wrinkle with a Roth solo 401k account. You can only contribute up to $20,500 in 2022, plus catch-up contributions of $6,500 if you're 50 or older. If you're able to save more than this amount, you will need to contribute the extra into the traditional solo 401k account. You can make both employer and employee contributions to the solo 401k, but your employer contributions cannot be saved in a Roth account, just your employee contributions. So that may be just as well, because many financial advisors feel it's a good idea to hedge your bets, including myself, for any tax scenario by investing in a mix of pre and post-tax retirement accounts. So this gives you room for a strategy in the future, regardless of what taxes may be, because that is a huge unknown for us. Ultimately, the choice of whether to invest your money in a traditional 401k versus a Roth 401k is a matter of age, income, location, and preference. So what other benefits are there for a solo 401k? The advantage of solo 401ks aren't limited to taxes. If your spouse works with you at your company, even part-time, they may be able to invest in a solo 401k as well. As long as your husband or wife or spouse works for you at least part-time, they can contribute up to $20,500 in 2022, plus catch-up contributions of $6,500 if they're 50 or older. You as the employer can then contribute up to 25% of their compensation, up to a total of $61,000 in 2022. This allows couples to invest more than $100,000 in tax-advantaged retirement accounts. And this is really powerful, especially if you've started saving later in life. This will help you catch up in that way. You can take a loan from your solo 401k as well. Most solo 401k providers let account owners take out 401k loans from their accounts, just as many traditional 401ks allow. With a solo 401k, you can borrow up to the lesser of 50% of the plan value, or $50,000. You must pay back the loan in 5 years or less, unless it's used to buy a primary residence, in which case you have up to 30 years to pay that back. So just because you're borrowing from yourself doesn't mean it won't cost you, though. You're required to pay your account interest comparable to what you'd pay for a similar non-401k loan. You'll also miss out on potential returns that money would have earned you if it had stayed invested. While you will eventually earn what you borrow back plus interest, that interest may be less than the returns the money would have earned if you had left it untouched and invested in the stock market. So this may fall under the category of just because you can doesn't mean you should. So you should be careful here. And if you have those other financial goals, plan for those and save for those outside your 401k plans if possible. Let's look at solo 401k contribution limits. We've talked about this a lot, but just as a recap, solo 401k contribution limits are the lesser of $61,000 in 2022, or 25% of your net adjusted self-employment income. This total rises to $64,500. I'm sorry, that was last year, $67,500 in 2022, when including the catch-up contributions for those who are 50 and older. So take advantage of that catch-up contribution. With a solo 401k, you make contributions as both employee and employer. As the employee, that's the $20,500 in 2022, plus the $6,500 in catch-up, or up to $27,000 if you're 50 or older. That includes the $20,500 plus the $6,500 catch-up, gets you to that $70,000 mark. And this is a part of your employee contribution. As the employer, you're the employee and the employer. As the employer, you can contribute up to 25% of your net adjusted self-employment income as well. The IRS calculates this as your net earnings from self-employment minus 1/2 of your self-employment tax and employee contributions you made for yourself. In 2022, the contributions have risen over 2021 by $1,000 on the employee side, and then from $58,000 to $61,000 on the employer contribution side. So if you've been contributing to these, make sure you increase that based on the amount increase for 2022. And then you have until the tax filing deadline for that year to complete all contributions, April 15th or October 15th if you file an extension. But you must establish the 401k plans before the end of the calendar year to make contributions for that year. So for 2022, you must establish your solo 401k plan prior to December 31st in order to take advantage of the 2022 contributions. With that said, the employer contribution part can be funded after the beginning of next year, up until the time that you file your taxes. So contribution limits if you participate in another 401k plan. This is really important. If you have a solo 401k and you also work for another company and participate in its 401k plan, the limits on employee contributions are cumulative across all accounts. The employer contribution limits are based on plans, meaning two unrelated employers can contribute up to the employer maximum annually. So note that anyone who is considering a solo 401k to save earnings from a side job for retirement should check first with your current tax professional and financial advisor who can help confirm your eligibility for the account, including your self-employment status. So how do 401ks, solo 401ks withdrawals work? Depending on when you withdraw money from your solo 401k and which type of account you withdraw from, traditional or Roth, you may owe taxes and or penalties. Here's what you need to know about possible taxes or fees on solo 401k withdrawals. Early withdrawal rules for solo 401ks depend on which type account you have. With a few exceptions, you must pay a 10% tax penalty on withdrawals from a traditional solo 401k account made before you turn 59.5, plus income taxes on the amount withdrawn. With a Roth solo 401k, early withdrawals of contributions are free of the 10% tax penalty and income tax payments because you've already paid tax on it. But you may pay the penalty and income tax on the earnings from your Roth 401k monies. You cannot withdraw contributions exclusively, meaning you will have to pay taxes and penalty on at least part of your early withdrawal from the Roth 401k. Here's some exceptions for solo 401k early distribution penalties. The IRS may waive the 10% early withdrawal in certain circumstances. You'll still owe taxes on any contributions or earnings that haven't been taxed, but the exceptions include these: medical expenses that exceed 10% of your adjusted gross income, permanent disability, certain military service, a qualified domestic retirement order or QDRO issued as part of a divorce or court-approved separation. In the case of distribution paid to an ex-spouse under a QDRO, the 401k owner owes no income tax and the recipient can defer taxes by rolling the distribution into an IRA. So even though the court is ordering distribution from the 401k to go to the ex-spouse, the person that's originated the 401k will not have a penalty or tax. And then assuming those funds are rolled over into the ex-spouse's IRA, there'll be no taxes, and that will continue to grow tax deferred. Unlike an IRA or SEP IRA, though, a solo 401k doesn't allow penalty-free withdrawals for higher education expenses or first-time homebuyers. Solo 401k withdrawals in retirement. Let's look at this. Withdrawals from your 401k after age 59 and a half incur no penalties, just like a traditional 401k, though income taxes depend on what type of account you have. If you have a Roth solo 401k, withdrawals are tax-free if made at least 5 years after the first contribution to the account. If you have a traditional solo 401k, you pay income taxes on withdrawals based on your current tax bracket. With a solo 401k, you eventually are required to begin taking withdrawals from your account, known as required minimum distributions, or RMDs. You can avoid RMD requirements by rolling a Roth solo 401k into a Roth IRA, which does not have mandatory RMDs. This is a huge thing to remember. If you keep your monies in the Roth solo 401k, then you will be subject to required minimum distributions. However, simply rolling the Roth solo 401k into a traditional Roth IRA, there is no current mandatory required minimum distributions for a Roth IRA. For solo 401ks, you must take your first RMD by April 1st of the year you turn 72. This is up from age 70. Again, in subsequent years, RMDs must be taken by December 31st of the relevant year. So don't forget those, because if you don't take your required minimum distribution, most people know that early withdrawals from a 401k or IRA before 59 and a half has a 10% penalty. But if you do not take your required minimum distribution, the tax penalty is actually 50% of the amount that you should have taken out. So don't forget that. And then opening a solo 401k really isn't difficult, but timing is important. The deadline to establish a 401k for you and your business is December 31st of the year you want to contribute. After that, it's really looking at choosing a provider that you want your 401k to be held at. You have to get yourself an employer identification number or an EIN number for tax ID, and that's the tax ID for employers. And then there's, of course, plan documents that are required to have you have on file for this. The IRS requires some paperwork. If you're working with a financial advisor, they should help you with this. And then again, you have to fund the account. So remember, when we're talking about a solo 401k, you have employee and employer contributions. So make sure you're monitoring each side and putting in the maximum amount available to you. And then, of course, you have to choose the investments. As with any retirement account, you'll need to determine how you want your money invested. So as easy as that sounds, you may need help, and don't forget to ask for help. Take advantage of our discovery session. See if a solo 401k might be a better option for you for your self-employment income and employer monies, to see if you can have better tax advantages and transfer some of that wealth from your business to your personal side. So if you need help, you have questions, book a discovery session with us. Thanks everyone for coming, and we will see you next week on Friday's Focus on Finances.